So, welcome everybody. My name is Julius Honey, and I welcome you on behalf of our company, Xsite Capital. At Xsite Capital, we partner with busy professionals to buy multifamily real estate with value-add opportunities. And through this, we grow the wealth of our investors. And as we do that, we aim to grow their minds also. Today's webinar is part of our commitment to continue to provide high quality educational content to our communities and our network. And we are definitely in for a treat today as we have one of the best tax advisors in the business here with us today. Clint Coons is a founding partner at one of the premier legal and tax advising firms in the country, Anderson Advisors. He also is not just a successful attorney. Clint is also a prolific writer who has published hundreds of articles and videos on the subject of real estate, investing, and asset protection. He has also acquired over 100 properties from single family to commercial buildings. So he's not just one that does the talking, he's walked the walk and is going to be able to draw from his personal experiences today to help educate us, especially with regards to what really works in real estate investing and what we need to avoid. So I'd like to use this opportunity to express sincere gratitude to Clint for taking the time to come and share his wonderful knowledge with our network. And on behalf of my partners, Tenny and Leslie and I, we deeply appreciate you all for joining this webinar. So Clint, I'll let you get started.
Hey, thanks for having me on. I appreciate it. I really love these Saturday webinars because it gets me out of my honey-do list that my wife creates for me every Saturday, of things she wants me to do. So this gives me the opportune time to say, oh, I've got to go to the office. I have other things to do. So today, for the next hour or so, we're going to be talking about real estate tax and asset protection planning. And so what I'm going to do here is I'm going to share out my screen. Should work this time. Start broadcast. Nice.
Yep.
There we go. Excellent. So a little bit about the firm and myself. Anderson was started between myself and my partner Toby Mathis. We started in '99, and it really was a culmination of both of us coming from different backgrounds. I'm not going to say a real estate investor when we started the firm, but I had a real estate background. My father was an avid real estate investor when I was growing up, and I've always said the only reason I think he wanted children is he saw the potential for indentured servants. And so my background was if I wasn't in sports, then I would have to go out and work on my father's properties. My brother and I would. And so we would be out there on the weekends, mucking out apartments, rehabbing properties. And it gave me appreciation for real estate and what it can do for you. My father, when I say my father, I mean my parents, my dad retired when he was 50. And since then he's been, I wouldn't say living a life of luxury, probably torturing my mom more than anything. But he doesn't have to work any longer because of what real estate was able to provide for them. And that really inspired me when I was growing up to see this wealth creation that was going on. And in fact, when I was in undergrad, I had dreams of becoming a contractor. So I worked as a framer for a number of years while I was going to college. But I live in Seattle, Washington. Well, not quite Seattle, but I live up in the Northwest. And if you've been up to this area of the country before, you know what it's like up here. From October through June, it's pretty wet. And it's not fun framing houses in the rain. So I decided to follow in the footsteps of my grandfather, who was an attorney. And I went to law school. And when I graduated, I had this passion to work with investors to show them the right things to do. Because as I was growing up, I saw that my father, he never did anything the right way from an asset protection or tax planning perspective. Because my grandfather never sat down with my dad and said, you should be doing this, this, and this. Because my grandfather wasn't a real estate investor. So he didn't appreciate the risks that my father faced. And so as a result, when there was a challenge that my dad was going to be involved in a lawsuit, the quickest way to end the lawsuit was to write a check to make it go away. And that was kind of his philosophy. And then on the tax side, his CPA didn't quite understand real estate because he wasn't a real estate investor himself. So after I got out of college, I realized how much my father had overpaid through the years in taxes that he didn't have to be paying because of the fact he had poor tax advice. And so it was with this background that I met my partner, Toby Mathis, who came from a litigation background where he would go after, and sue people. And we formed Anderson with this in mind when we set up the firm, that we want to help individuals to protect their assets and reduce their taxes. And that was kind of a unique concept at the time because most firms didn't do that. They stayed in their lane. And if you go to your attorney, you try to talk about taxation, he'll say, well, you got to go see a CPA. And then you go to see the CPA, he doesn't understand what the attorney's recommending and vice versa. And then the client becomes paralyzed. And I can't tell you how many people I run into that this reoccurring theme. I set up a few entities to engage in real estate investing. I've never done anything with them. They just sit there because I don't know how to execute with them. Or I am confused because my team of professionals do not seem to be on the same page and they appear to be working against one another. I guess it's like going to multiple doctors and you go see 3 doctors and you get 8 different opinions and you're wondering, what should I be doing for my medical care? And as a result of that, I would assume as a patient, you wouldn't do anything because you don't know who to trust, what advice to follow. And this happens a lot when it comes to investing in real estate. So we created a firm with that in mind. And when we started out, we had about 15, 20 employees. Now we've grown the firm to over 220 employees, and we're in multiple states currently. And it's been a work in progress, but it's always been with our core philosophy in mind that this is what we stay strong to, is protecting people, showing them how to create structures, which I'm going to share with you today for real estate investors. And what I've learned along this journey when it comes to real estate investing, because although I am successful in my investing, and my portfolio now is nearing 150 properties in multiple asset classes, it didn't start out that way. In fact, I struggled at first to get my real estate investing going. And there were a couple reasons why. Number one is I focused on the wrong thing, that I focused on tax planning as being my number one goal when we started Anderson, and I wanted to reduce my taxes down to 0. And I hear this a lot when I'm working with my medical professional clients. They come at me initially like, how do I reduce taxes? I'm overpaying in taxes. I'm getting killed state and federal. And I'm sensitive to that. I understand that. Everyone wants to reduce their taxes. I wanted to reduce them so bad that after 2 years of running Anderson, I reduced my taxes down to 0. So I could make $500,000, $750,000 and pay 0 federal income tax. And I can tell people this from the front of the room, who wants to do this? And everyone raises their hand that sounds like the best plan. Well, the problem in approaching it just merely from a tax standpoint is that you impair your ability to grow your portfolio. Because part of growing your portfolio and getting into deals and expanding requires that you have access to what we refer to in the industry as OPM, other people's money. And that could be banks, portfolio lenders, private money lenders. So wherever that money's coming from, many of those individuals with whom you'll be seeking financing from, they want to see that you have the ability to repay. And the way they determine if you have ability to repay is by turning in your tax returns. And so I had this issue where when I wanted to start my real estate investing and start growing my portfolio back in 2003, that I would go in, apply for a loan. They would say, let me see a copy of your tax return. I'm like, nah, you don't want to see that. No, we need to see a copy of your return. And you would just hand them over. And when they take a look at the return, they would come back to me and they say, well, how do you expect to get a loan? You make no money. I'm like, oh, no, I make money. It just doesn't show up on my return. And when you tell someone that, then they assume you're engaging in illegal activity, because people engage in illegal activity, like drug dealers or something like that, their money doesn't show up on their tax return. So it taught me this important lesson, which I started learning from other successful real estate investors, is that real estate investing, regardless of what you're doing now, you need to look at it like a business. And there are a number of different strategies that you should employ to ensure that you can grow that business most effectively. And I've seen it where individuals that have been investing for 8, 10 years, they have 6, 7 properties. Great. but they wish they had 21 properties, 35 properties, where I'll see those other investors that have been going at it for 4 years and they're already at 20 properties. And if you compare them, there's an obvious difference between the two. It's that the guy that has been at it and for the short period of time has the 20 properties is he's taken on investing with a business mindset. And for a lot of us that go through higher education and we get degrees, this isn't taught in school. You're not taught to think this way. And so you approach it many times with the same Socratic method or the procedures you went through in college that to get to your higher degree. And it just doesn't translate well into investing or thinking about it from a business perspective. And then once you make that shift, you can really see the change in your investing portfolio. And so the vast majority of my growth occurred after I started paying more in taxes and got away from this singular mindset that taxes were the road to success for me by eliminating that. And starting in 2008, 2009 is when it switched. And I started flipping real estate, and I moved from flipping real estate into buy and hold, single family. And from there, I moved into commercial real estate, and now I'm into self-storage. And so it's been a journey, and it's something that I've realized that entities along the way can help you or they can hurt you. And so understanding these tools and how you set them up, I found can be extremely beneficial. All right, so here's some of the services we offer at Anderson. Of course, we set up LLCs, corporations, land trusts. We have tax and bookkeeping services as well, because we realized that we needed to bring in a tax component into the firm, because so many professionals, we would set up the structure, and I would recommend a C corporation to someone. They'd go to their CPA, and he would basically throw salt water all over it and say, why the hell are you doing that? That doesn't make sense. And of course, the client can't necessarily explain it in the detail I can. And even if they could explain it to that level of detail, the CPA just was not familiar with it, didn't see the benefits, doesn't understand how that correlates to a real estate investor. So we actually had to bring it all in-house. And that's what we did a number of years ago to help our clients so that they do not get that conflicting advice, and they have a team of professionals that are working on the same sheet for them. Retirement planning, we also set up different types of retirement plans for our clients, again, with the goal in mind. I'm going to share with you today how you can access your retirement funds and put them into real estate. And then the last thing that we focus on, which is I think one of the more important legs of what we do, is the business planning strategy, showing you how to take what it is you want to do and treat it from a business standpoint and build a business around it so it can help you do more and achieve your dreams faster. Because everyone has different reasons for investing. Either you want to build portfolio wealth for future generations, you want to build retirement income, or you want to replace the income you have right now because you look at the medical profession, you see where it's going, and there's uncertainty there. Julie and I were just talking about reimbursements and what's going to happen 1, 2, 5 years down the road, because it seems to me, I have a lot of friends who are medical professionals, doctors that I hang out with routinely, and we start drinking a few glasses of wine and we start talking about this stuff. It's as if they're always the boogeyman. Everyone wants to blame the doctor for the problems with the medical community and in the insurance and why prices are so high. And they think that they make too much money, but no one's ever been in their shoes, walked in their shoes, spent the time, sacrificed to wait until you're 30 years old, 32 years of age to start your career. And then when you start your career, you have several $100,000 in debt. So you're behind the 8 ball before you begin. And then again, those people that will come out and complain that the doctor's being paid too much money, they still want you to save them if they're sick, right? But they just don't want to pay for it. It's an odd mindset that I've found. So there's a natural, I think, inclination for people that see this to want to move into real estate, because that is a safety net from my point of view. I've been a stock market investor, didn't care for it. I did really well for 7 months, made close to $1 million and lost it all in 7 weeks when the market turned. And I said, that's not for me. I'm going to stick with real estate. In fact, I used to bug my father. I'd call him up some days and say, Dad, I made 40 grand and it's 10:30 in the morning. What have you done with real estate today? My father would just pause for a moment. He'd say, you're nothing but a damn fool. And he'd hang up on me. I'll tell you what, sometimes dads are oftentimes right, actually. So here are the traits of a great plan: asset protection, tax planning, and business planning. And that's what we're going to be talking about when we start talking about some strategies here. So here's some of the tools that we use: limited liability companies, corporations, and land trusts. These may not be that familiar to you if you've not been studying up on real estate investing or seen any of my videos on YouTube, how these tools can be implemented. The key here is implementing them in a way that helps you with your investing and does not hinder you with your investing. And so we want to look at multiple sides. We want to make sure that your assets are protected from you. Okay, that's key, because as a doctor, let's face it, you have a high degree of liability. If there's a plaintiff's attorney out there and they know that there's a doctor on the other side, they're just going to take that complaint in the damage section and add a few zeros onto it, because the presumption is you're wealthy. And even if you don't currently have the wealth, I know this: you will be making money. So I will then garnish those wages, so I will get paid. And so what we want to do for medical professionals is make sure that our assets are protected from our personal liabilities. I mean, it's really scary right now on how many different ways they can sue you. They're just going to throw you in med mal claims, or even outside of that, just personal injury claims. So then on the flip side, we want to make sure you're protected from your investments. So let me just start then showing you here what we can look at. Okay, so I got a question here: C Corp for real estate versus S Corp. We're going to get into that when we start addressing the different types of structures. So let's just look at passive investing for a moment. Okay, so with passive investing, what you're doing is you're going to buy and hold longer term. And so when we're looking at passive investing, there's a couple different ways we can structure things. One of the ways that most people, the way they'll structure it, is set up a limited liability company in the state where they're going to obtain the passive investment. Now, I want to break these passive investments down into two different categories. On this side, we're going to be talking right away initially about single family. So if you're a single family investor, there's one strategy. And if you're a multifamily investor, there's going to be a slightly different strategy, the way we set up the LLCs. So you're going to create a limited liability company. And a lot of people will do this. They will take properties and they'll stick them all inside of the same LLC. And of course, you're going to be down here as the owner of that LLC. Your spouse is there. And so together you own this company. Now, when you look at that, you wonder, do I have asset protection? Well, yes, this is an accurate structure. If you created this type of structure for your investing, you would have asset protection. And here's the way it would work. If something happens to one of these properties with one of your tenants, they bring a claim for toxic mold, maybe your tenant had a dangerous animal, a dog, and the neighbor was bit when they jumped into the backyard because her dog was being mauled by this dog that snuck into the neighbor's backyard. Maybe the tenant was engaging in a little home-based business of cooking meth, and then they burned themselves up, and now you're being sued because the smoke detectors in the house were not working. Well, that's because, of course, the tenant disabled them so they could cook their meth and not set the smoke detectors off. I'm just giving you cases where our clients have been involved with, where they've been sued over these ridiculous claims from tenants. And so real estate is a dangerous asset, and you have to appreciate that risk. I was telling Julia that many times at my live events, I will spend 3.5 hours just talking about threats. And I tell people, I'm here to peddle fear for the next 3 hours. And it's intentional, because if you don't appreciate threats, you won't know how to address them, and you won't take the necessary steps to minimize that risk. So when people don't understand the threats or appreciate the risk, they put a structure together that looks like this. And here is what can happen. If something were to occur with this property right here, then a claim is going to be brought against the limited liability company. You're protected. We're not going to sue you. You don't own the property. We're going to sue the owner of the property. And then whatever the LLC owns is now subject to attachment. So if we obtain a judgment against this limited liability company for $1.25 million, and you have policy limits of $500K, all right, there's $750K outstanding. So what am I going to go after to get paid? This house, and this house. So you've just risked all of your investments by placing them all inside of one limited liability company. And here's what happens a lot of times. When I'm teaching this subject from this perspective, I get pushback from professionals who do not understand real estate investing. As a single family investor, why do we invest in single family? Is it for appreciation? No, those are flippers. Flippers are buying for appreciation to turn the property and sell it and pull that equity out. I'm investing in single family personally for portfolios investing that I'm going to hold it long term. It's going to be passed on to our children. And it produces a steady stream of income. So the appreciation, that's nice to say, look at my balance sheet, here's my net worth, okay? But at the end of the day, what does that really mean? Until you sell it, it means nothing to you. So if that property has $500,000 equity in it or $50,000 equity, it's irrelevant. To me, what I'm banking on is the cash flow that comes off of the property. So if I generate $800 from this property, this one generates for me $1,000 a month, this one throws off $1,200 a month, and this one kicks off $800. All right, so what do we have there? $3,800 a month cash flow. That's how much I'm bringing in off of this portfolio. One lawsuit takes away my equity, which, again, it's not my concern. It's not why I'm investing. I mean, you don't want to lose it, but it takes away my cash flow. And if I'm banking on this to retire, to supplement my income, to send my child to get his college education, you've just taken away $40-some thousand a year out of my wealth accumulation. That, to me, is what is at risk here and why I do not recommend people stack properties inside of LLCs. The preferred method would be to create separate LLCs for each property. That way, we've minimized the total hit to our cash flow should a lawsuit develop in either of these limited liability companies. So if the lawsuit started here for a toxic mold claim or COVID-19 claim, then the most I stand to lose is the cash flow and the equity associated with that one property. So if this one threw off $1,000 a month in rental income, I lose the $1,000, but I maintain the $2,800 a month from my other properties. That is what I'm getting at when you're thinking about your asset protection strategies, creating these LLCs. Now, the other thing to consider, and this is, I think, is really important when you're thinking about asset protection, is where or how do you structure the LLC? Let's assume that I'm going to set up a limited liability company here, and I'm setting it up in Florida, and I'm going to be down here as its member and manager. We're down here on this company, this LLC that we set up, and it's going to own this property. Let's assume that you multiply this by 6. So you have 6 LLCs, and you've structured them all in Florida like I just showed you. Well, if you've ever been through a lawsuit, or maybe you haven't, but what are the attorney on the other side going to look at? They want to know how deep are your pockets. MD, that already gives me an indication of how deep your pockets are. An asset search, a simple search, is also going to tell me how deep your pockets are by determining how many assets you hold. Well, when you set up an LLC, that's an asset. It tells opposing counsel, hey, this guy's pretty successful. Look at all the companies he's created. How do they find out how many companies you've created? Because when you set up your LLCs and you set them up where you're listed as the owner of the limited liability company, the vast majority of states like Florida require that you list who the members of that LLC are, who the managers of that LLC are. So all that information is now public record. So if you created 6 LLCs in Florida and you list yourself as the member or manager, now that's public information. So a plaintiff's attorney can jump onto sunbiz.org and pull all this information up out of the Florida Secretary of State's website, and they know how many entities you have. And then they can search those entities to find out how many properties you have. And so then they get a good idea to determine whether or not they settle for policy limits or they go after the deep pocket defendant. A client of mine in Los Angeles a few years ago was in the same situation. He and his father were jointly named in a lawsuit because my client runs some nightclubs. And one of his patrons left the nightclub and was hit by a car from another patron that had left about 3 or 4 minutes before these other 2 guys actually walked out. One guy lost 2 legs and the other guy lost 1 leg. And so they sued my client and they sued his father who owned the building. My client ran the nightclub inside of the building. And just to make it real quick here, they settled with my client for $1 million policy limits, but they wouldn't settle with the father who owned the building. And the stated reason why they wouldn't settle with him is because they ran an asset search and they found that within Los Angeles County, he had about $15 million, $20 million in hard assets, real estate, that were listed under his name. He couldn't understand why they didn't force his son to pay. And the reason why is because his son had taken steps. I started working with the son, of course, prior to all this going down, where we removed all of the assets. He has over $25 million in real estate, multiple businesses, and not one of those assets or businesses point back to him. So when the opposing counsel ran their asset search, they found the father's assets, but they couldn't find my client's assets. So they made an assumption, and this is what we want them to think. Hey, you're going after someone who really doesn't have much of anything. Take the policy limits, go away. How did we do that? Well, when you set up structures like this, you'll definitely get asset protection in this example here. If somebody sues, you're protected. But what happens on the outside if you get sued? This is what I've been alluding to here. People coming after you. I mean, the other reason why we create these structures is to protect our investments from lawsuits that start right here. So people that are coming after you and they want to take a piece out of you, I don't want them to get after my investments. I don't want them to get after if I have savings and investment accounts, say with Charles Schwab, I don't want them to get those assets. If they're in my name, they're completely exposed to my creditor. So I want to create a small footprint. And the way I do that is by setting up the following. Typically what we'll do then is create a Wyoming LLC here. Now the reason I create the Wyoming LLC is that Wyoming does not collect any information on its owners or managers, members or managers. The only information Wyoming collects when you set up an LLC in that state is the registered agent, the name of the entity, and its business address, nothing else. So I can set up an LLC for you that you fully own, control, run, and you're not going to be associated with it at all. So this is the first step. So this is the first entity I create. And this is what I did for my client in LA. Then I create the LLCs that own the various pieces of real estate. So in his case, it was California. So I set up all these California LLCs right here to own property. And under California, you have to file a statement of information that lists out who the members in each of these LLCs, who are the members in each of the LLCs. And on the statement of information, because I made the LLC member, this Wyoming LLC, I submitted to California the following. LLC number 1 is owned by Wyoming LLC. LLC number 2, owned by Wyoming LLC. 3 and 4, same thing. So when somebody runs an asset search against this limited liability company here to see who the owner is of this particular property, it gives them this information, Wyoming LLC. Okay, great. Well, let's go to Wyoming and see who the owners of that LLC are. They go to the Wyoming Secretary of State and they punch in the name and they get back this. No information available because it does not collect, Wyoming does not collect this information. So it provides you anonymity of ownership. It also works on the reverse. If I'm coming after you individually, and I run your name through the California Secretary of State's website to see if you own any interest in any companies, because you've set up all your red boxes, the state-specific LLCs that own your property, to be owned by a blue box in Wyoming, you're no longer associated with it. So you've taken and removed your name from real estate by putting it into the LLC, and you remove your name from the LLC itself by having its ownership held in a Wyoming limited liability company. So this is what we refer to as anonymity. And it's often, I always look at it as your first line of defense. That is, they can't sue what they can't see. And so I don't want people to know what it is that I own. So when I tell you I have a portfolio approaching 150 properties, they're not in my name. And I hold them in a certain manner so that people cannot trace them back to me, nor can they search me and find the assets that I hold. I was teaching an event in Georgia about 9 years ago, and as an attorney that was attending my class, and I just on the side, I mentioned I had a warehouse in Savannah. And I said, is anybody interested in buying a warehouse? I've got it for sale, just I was joking around. And the attorney came back the next day and said, hey, you're a liar. And I looked at him, I said, no, I'm a lawyer. And it's just a matter of pronunciation, I guess, to most people, but why would you start up the class that way? And he said that he had searched the records in Savannah and my name didn't appear on any real estate. I looked at him and said, were your ears plugged with wax yesterday? Didn't you hear anything that I had said? Is that I'd set up my structures so individuals like you can't find out what it is that I own, because I don't want you all up in my business. That's my business. You don't need to see it. Whether or not you believe I have it, I really don't care, because I don't operate on a need to show basis. Hey, look at how successful I've become. Here's my portfolio. The only time that information gets disclosed is whenever I'm applying for a loan and they want to see a copy of my financial statement. So you want to keep it private. Now, a key thing here in creating this type of structure, the next thing we look at is the business planning side. So here we got the asset protection in place. And the reason I'm using LLCs is also to preserve taxes. That is, with real estate, you have flow-through depreciation. Means it flows through the LLCs down onto your 1040. And the issue you run into, number one, in using any entity other than an LLC is that you could lock that depreciation up so that you cannot absorb it against your other forms of income if you qualify to do what I'm about to describe. And therefore, it becomes locked until you sell the property. I want to keep that free flowing so it doesn't get locked up. And the LLC allows us to do that. Whereas other types of structures, limited partnerships, corporations, are not as forgiving there, and they can screw up your depreciation flow. So the benefit of the depreciation flow from a tax standpoint is that if you're in the right situation, let's say that I have all these properties here, and on paper, they produce for me a $45,000 loss. Okay, it doesn't mean I got the money. It's just that by depreciating the property, I'm able to take that depreciation and offset it against the rental income. And if I have enough depreciation, that is, it exceeds my income coming in, that shows a paper loss that I can then use in certain circumstances against my W-2 income from my medical practice or just from working at the hospital. So how do we obtain that? Well, number one is to ensure that you have the depreciation available. So it's by buying property and then performing what is called a cost segregation study on the property to accelerate depreciation, to lower your taxable income. So that's one way we do it. But in order to get that, though, we want to make sure that you can write it off on your return. So probably about, 17 years ago, I was teaching an event in Florida, and a gentleman walked up to me. He's an attorney. I remember we're good, fast friends now, but he came up, he had this big, long ponytail, hair pulled back, and he said, hey, what do you do when you have, I forget how many properties he had at the time, 300 pieces of property, and you have 300,000 or some in losses every year. You're making $1 million and your CPA tells you can't do anything with it. I said, excuse me? He said, well, I'm an attorney. I'm a personal injury attorney. I make over $1 million a year, and I have all of this real estate I've purchased, and I have about $300,000 in depreciation losses, and it just sits there, and I can't use it against my law firm's income. I said, okay, what does your wife do? He said, well, she runs it all. She's the one that's helped build all of this. She's there every day managing these properties, sending people out. And I said, well, it's simple. Here's how we fix your problem. As long as she spends 50% of her time and 750 hours on real estate related activities, we're going to make her a real estate professional. In addition to that, we're going to take an aggregation election to treat all of your real estate activities as one for tax purposes. If we can justify your wife being the real estate professional because she meets that test, 2, we make the aggregation election on your tax return, we will then be able to free up that $300,000 a year. It saved him $100,000 basically put back into his pocket the second year after we started working with him in taxes by setting him up in that structure. His CPA did not understand this, and he had been overpaying. The way I looked at it is that for the 5 years preceding years, I mean, he paid in $500,000 he did not need to pay in to the IRS because the CPA did not understand real estate taxation. So when a medical professional starts working with us and their first question is, well, how do I reduce my income? Real estate is a path to do that. But in order to get there, you first have to qualify a spouse as a real estate professional. So if your spouse is not engaged in some other full-time profession, then you would have your spouse work on the real estate side and keep track of the hours. And by doing so, then you're able to free up your deductions that many times we look at as higher income earners and say, I've got these deductions sitting on my return, but I can't utilize them. We just haven't figured out a path forwards yet to utilize those. So that's important. The second thing is with this LLC down here, this blue box, have this blue box down here treated as a partnership for federal tax purposes. Each of these red boxes would be disregarded. Okay, so what do I mean by that? That the red boxes do not have to file federal tax returns. Because some people look at this structure and they say, wow, you're just going to kill me, Clinton, tax and accounting costs. No wonder you set up a CPA group inside of your firm. You bring all your clients in and now you're making tons of money filing all these tax returns. Not at all. These entities here do not file tax returns, so just wipe them out. No tax returns are required up there. The only entity in my structure that files a tax return is the blue box right here. And that's targeted, that's specific. It doesn't have to. I could structure you so you don't even have to file a tax return for this LLC as well, but it's not beneficial for you. Because as you grow your portfolio, one of the challenges you're going to face going forwards if you're working with traditional lenders is your debt to income ratio. So if you're financing and leveraging, which you get a better cap rate when you leverage on your investing, they're going to look at your 1040 and see how much income you show, from W-2, but also from your investment real estate that shows up on Schedule E. Now, on Schedule E of your 1040, there's 2 pages to it. We often refer to it as page 1 and page 2. Investors who hold title to real estate in their own name, it all shows up on page 1. Page 1. So what happens on page 1, you list out each property here, its expenses and income, and all that gets listed right there. And many people will have multiple pages here if they have more than 3 pieces of real estate, because I'll have to keep listing them all out. Well, the problem with carrying real estate on your Schedule E in that manner, that is in your own name or through an entity that's disregarded, is that if you showed income from all your real estate of $100,000 and you're applying for a loan and you're pulling in $350 from W-2, how much income do you think you make on an annual basis? Well, I'd look at that and I'd say, oh, I make $450,000. You do, but how much do they count for applying for that loan from your debt to income ratio? Well, because all that income shows up on your 1040 Schedule E page 1, they're not going to give you $100K there. They're only going to give you $75K because they got to knock off 25 to 30% for vacancies. So even though you show it for tax purposes and you bring it in, you don't get to count it. So as your portfolio grows, what happens is your debt to income ratio starts to creep up on you and can possibly take you out of deals. So what I learned a long time ago is let's take this company right here, treat it as a partnership, make it file a tax return. Because if it files a tax return, then it gives us what's called a K1 that represents our share of the income. So if it's my wife and Tracy and I own this entity together, I get a K1 for 50% of the income. She gets a K1 for 50% of the income, which means she has 50K in my example, I have 50K. So that all shows up on our 1040 as 100K. But the difference is because it comes through a K1, it shows up on Schedule E page 2. Just as a line item right here, $100,000. Now when you're going into underwriting and they're looking at your 1040 tax return, they'll give you 100% credit for that and they won't take out any percentage for vacancies on your rental properties. It's just a little tweak that you have to do with the way you hold your assets to bump up your debt to income or bump up your income for purposes of qualifying for loans. See, this all goes back to my point earlier about structuring this as a business. So many individuals, they only see one leg. They see asset protection or they see tax planning, but they don't see the subtleties that allow people to do more. Here's a perfect example of that. So this guy called me off my YouTube channel. I've been watching me on YouTube for a while, and he had bought a multifamily, and he set it up in an LLC with the assistance of his CPA. So they set up this limited liability company. I think it was in Kansas, if I recall. So he sets up this LLC in Kansas, and the CPA who assisted him in creating the entity structured it as a disregarded LLC. Remember, so it does not have to file tax returns. He bought this as a value add that he intended to flip. So stabilize, value add, turn around, sell the property within 3 years when you've increased its value and you've got 95% occupancy on it. He did this. 3 years later, he's trying to sell the prop. In the issues he keeps running into is this buyer comes along, ties it up under contract, falls out under financing. This guy comes along, ties it up under contract, falls out under financing. So he's on his third buyer now. And he could not figure out what the hell was going wrong. He said, the property performs. I started talking to him. I said, it's obvious. When you sat down with a CPA, he didn't ask you a question, which is fundamental to any investor, is what is your intent? Why are you buying this property? What do you intend to do with it? Do you want to, is it going to be a portfolio investment? That means you're going to hold it long term. Is it going to be a flip? Is this, a value, or is it going to be a value add deal that you're going to turn? So it's an investment where you're going to value add, and then it's still a turn, but it's not a flip. A flip is a property that you buy, rehab it, and sell it within a year typically. In this type of arrangement, you're going to hold it for more than a year. Depending on what you're doing here, it's going to change how you choose to treat that entity for federal tax purposes. If he said to me, I'm going to flip it within 6 months, then I'm going to set this LLC up to be treated as a C Corp or S Corp, if that's what he intended to do. If he told me, I'm going to treat it as a portfolio investment, I'm going to pass it on to my kids in the future. All right, well, we could treat this as a disregarded LLC held down here by that blue box that's going to be treated as a partnership. That's how I would have structured it. If he told me that he was going to treat it as a value add, then I would structure this so it's treated either as an S Corp or as a partnership for federal tax purposes. Why? Because when I looked at his deal, I said, the problem you're having right now in trying to sell this property, which is going to force you into an installment sale, is that lenders see an LLC. Lenders assume then that that LLC is filing a tax return. Because you set it up as a disregarded entity, you do not have a tax return to provide them. And the reason they want to see this tax return is because they need to verify the income and expenses associated with the property, the balance sheet, profit loss, all that stuff. And so tell me if I'm wrong. Have you been asked for this? And he goes, oh yeah, they keep asking for this information. I said, I know, and you can't provide it. So it makes the lenders very uncomfortable because they don't know if you're, screwing with the books or not, because basically now it just comes down to whatever you provide them. Whereas if it's on a tax return, people tend to be more honest on a tax return because there's penalties. It could be a felony. So that's what they need to do their underwriting. You can't provide that. So unfortunately, this is going to be a tougher sale for you. You might have to do an installment sale, carry back the note for 2 years so that your operator can get in there, the owner, and then pay you for a while, then come in and refinance the property out. But there's so much risk in that because when you sell a multifamily, you don't know if that buyer understands or has the know-how to operate a multifamily property. And what could end up occurring is, you're involved in a lawsuit a year from now because they assert that you misled them on the sale of that property because it doesn't perform any longer like it did when you sold them. And they'll say it's your fault because you were concealing information, when in reality is they don't know what the hell they're doing. And that's been my experience a lot with people that want to get into multifamily. They think, oh, I'm just going to go out and buy a multifamily property and that's what I'm going to start with. You don't start with that. You start with people who are known operators and know how to do it and learn from them, or don't do it at all and invest through them. Because I grew up in multifamily with my father, and I saw firsthand how this all plays out. When he sold one of his buildings to the Seattle Low-Income Housing Institute, he offered to stay on as the operator for a period, I think it was 6 or 8 months, and of course they'd have to pay him. And they said they did not want him to stick around as an operator. They said, nope, clean deal, we're done with you, cutting all ties. And within about 5 months, the property had about 65% occupancy, down from over 90% occupancy. At that, or let me say not occupancy, paying tenants. So only 65% of them were paying. They were starting to evict all these people. So they turned around and they threatened to sue my father for concealment and misleading them as to the nature of the property. And so I got involved in this transaction as well with them. I said, wait a minute, no. There are a number of things you did wrong in operating the property, and we can point those out. An offer was made to keep him on and assist you in operating this property, to teach you what you don't know about operating multifamily, and you declined that offer. So the lawsuit we ended up we didn't go to a lawsuit. They were just threatening. They ended up walking away on that deal, but they wanted to rescind the transaction initially. So this can happen, and then you have to take the property back. So what you would do if you're going to buy multifamily, you're going to treat it as a value add, make sure this entity is filing a tax return. So you grease the wheels so your buyer that's going to come along has everything he needs to provide to the underwriter that's going to be setting up this loan for him to acquire the asset. And so again, that's the business standpoint here. Understanding that putting together real estate is not just throwing LLCs on the page. It's about thinking down the road. This is what I intend to do with it. So this is what I need to do to make sure that I can reach my end goal. So this is how I would structure the multifamily commercial building. This would be, again, filed in the state where the property is located. And we could also then throw it back into an LLC down here for the anonymity component. If you're going to flip property, there's a question here, C Corp for real estate versus S Corp. If you're flipping, then we recommend you create a C Corp for your flipping of real estate. And the way we do that is that we don't want to flip through the corporation itself. We'll create separate LLCs for each of your flips. So when I started flipping in the Las Vegas market, 2009, what I was doing is I created a C corporation. I would buy the property in an LLC that's owned 100% by this corp. So again, this LLC is disregarded. This corp here was a C corp. Clint owns it. And Toby, my partner, we both own this together. And we would flip the property. Let's say we made $50,000 off this deal. The cash all flows into the corp. So you get that $50K into here. And then after the flip was over, we dissolved it. Now, the reason we would dissolve the LLC, and we chose to structure it this way, is that I didn't want any buyer to come back against me at a later date and try to pinch me, squeeze me for money by bringing some bogus claim and filing a Liz Pendens against my current projects, tying them up from being able to sell them. So by setting them up in an LLC format, you're able to sell the property, shut the LLC down. So in that disgruntled buyer that's not happy because the real estate market has dropped by 30% in his particular area because of the recession, when he goes to the attorney and say, listen, I bought this property from Redbox LLC and there's a number of problems with it. And they're all right, great, we'll sue them. So they go back and they look up Redbox LLC and they find out this, the company's no longer in business. So what are you going to do then? Sue a company that's out of business? I think not. You're going to choose a different path, which is obviously going to be this. Well, listen, I could go after that company, try to figure out who the owners are. We can make some obscure legal claims. Maybe I'll get you some money. Maybe I won't. But here's the deal. Originally, I agreed to take this on a contingency fee basis. Now that deal's off the table because the facts and circumstances have changed. And so if you want me to handle this case for you, I'm going to need a $15,000 retainer. That is enough to make that client walk out the door, because they were hoping to get a free payday out of it where the attorney would bank on it and cover it, and they wouldn't be out of pocket. So flipping, we run it through this strategy. So you want to know, should I use a C or an S corp for this? I like C corporations right now because they're taxed at a flat 21%. So if you're doing business on the side, real estate on the side, actively, that's going to be active income to you. It's going to show up in your Schedule C. So if you flip property, wholesale, that type of investing, that's Schedule C income. So you got your W-2 from the hospital, you got Schedule C from the flips. Again, this impacts your ability to borrow, because when you go in to obtain a loan and you turn over your tax returns, they see that you're in business for yourself. And they're going to go, well, what is this Schedule C income? Well, I flip property. What the hell, you flip property? I thought you were a doctor. Well, I do this on the side. Oh, well, we have a problem with that. We've been burned by flippers. And so now you're going to take yourself out of the ability to qualify because of the activity on your return creates too much risk. That's a serious problem. The other issue you have with running this activity through an S corp is its flow through. So it doesn't hide the activity. So it flows down on your return via K1. So then the lenders know about it. With a C corp, it contains all of that activity, keeps it off your 1040 because it files its own tax return. So no one knows what type of activity you're engaging in because nothing shows up on your return. By having it in that C corporation, not only do you keep it off your tax return, if you do want to, you have control when it will hit it and how it'll hit it. If I want that income to flow onto my tax return, I can pay myself out a salary, a W-2 income. So now it just looks like I make more money from my job, which then makes me more attractive to lenders. Or I leave it in there and it's taxed at a flat 21%. I mean, what is your individual income tax bracket right now between state and federal? Is it greater than 21%? One of my clients, I'm working with on the East Coast, his state and federal tax rate combined was close to 45, 48%, somewhere around there. And he flips multifamily deals and he makes really good money doing it. And the strategy I recommended was to convert his S corp to a C corp. And his CPA, again, she was against it. She goes, why would you do that? Double taxation, this is stupid. Clint doesn't know what he's talking about. I said, listen, here's the deal. He's making $1 million. And here's what's going to happen. Of that $1 million, he's going to give $480,000 to the federal government this year. I'm proposing we give $210,000 to the federal government rather than $480,000. So $480,000 minus $210,000. Where does that leave us? $270,000. So I keep $270,000 in his corporation. We take that $270,000, we do another deal, we generate another $300,000. In 10 years doing that, how much more money will he have? $3 million. So your double taxation really doesn't factor in anyways, because when he retires, he'll take it out as a dividend, be taxed at 20%. He no longer intends to live there. He's already told me he's going to retire in Florida. So he's going to be in a lower tax bracket overall than taking that money now. So this is a wealth accumulation strategy that's founded upon tax arbitrage, understanding where he's at today versus where he's going to be in the future. You haven't analyzed it that way because you've been taught to look at C corps as double taxation and not realizing they can be a wealth accumulation tool for certain types of real estate investing. And so this was something that opened his eyes up, the fact that he'd been overpaying for a couple of years based on the fact that a CPA did not embrace the tax law change that occurred a few years back, the Tax and Jobs Cut Act. My own firm was an S corp. And once that Tax and Jobs Cut Act came about, we converted from an S corp to a C corporation for this reason right here, 21%. And for the reason that I stated earlier, I don't want lenders to know that I own a law firm, because this firm has been an anchor in growing my portfolio. You may say, well, it hasn't. Clint, you're up to 150 properties. There should be more, But what happens when I apply for a loan, they see that I have an S Corp and they want to know everything there is to know about my S Corporation. They get up into my business. They want my tax returns, my profit and loss, balance sheet, run liquidity tests against it, and it just screws it up. One last thing I want to leave you with, because I know we're pushing the time right here. If you have IRAs and you want to bring them to bear, here's another strategy. So if you had an IRA right over here and you would like to utilize that in investing, what we can do is we can roll it out and we can put it into a solo 401k. And it doesn't matter if you have a 401k with your hospital or your practice at all. You can still set up a different one, or it could be a self-directed IRA, whatever we need to do. Now, when you set this up, once you have this entity set up, you can then go out and create an LLC that's owned by the entity, and you can use those funds in here to invest into real estate, to invest into syndications. When you roll it out of the context that you currently have with your existing IRA custodian and you put it into this vehicle that you've created that gives you this option, now you're able to invest in real estate. More importantly, what we've done for clients in this scenario, let's say you had $200,000 sitting over here and you have another $250,000 on the side, and what you've done is you put it into an LLC like I've described for asset protection purposes, and you want to buy this multifamily up here, and it's going to require the down payment to pick up this deal. It needs $450,000 down to buy this. Well, you have the ability between this and this to buy this. The way you do it is you structure this LLC so you partner with your own retirement account. You bring $250 in here, $200 in here, you have your $450,000, you buy it. You can use debt in this scenario as long as it's non-recourse debt, so it's commercial loan, so it should be non-recourse, which means you don't have to sign a personal guarantee. And now what would happen on a monthly basis, 40-some%, let's just say 45% of the income goes back to your retirement plan, tax deferred, and then 55% flows down to you. Would be taxable, but you have the depreciation to offset it from that commercial property. So maybe you don't even have to pay tax on the personal side. So what I'm saying is that if you have the right tools set up and in the right scenarios, you're able to do more with your actual investing. And I'll give you an example how this stuff actually works. So in this particular case here, it's a client, and her scenario or her issue when she sent me this email was that she had this judgment against these Hawaiian real estate developers that owed her $2 million, and she couldn't collect on it because the attorneys didn't know how to break through their structure. And she wanted to know if I knew of any ways to, execute on what's called a charging order. So she sued him personally and got this judgment for $2 million on it. And she noticed her living in plain sight and luxury condos and driving these fancy cars. And I said, well, before I tell you how we can do it, we first need to know, do you have a diagram of what their structure actually looks like? Because I'm sure you have that by now if you're able to get this judgment. She said, oh, no problem, let me send it to you. And bam, this is what I received. And I looked at that, and she goes, well, what do you think? I said, I think you're going to be in the same situation, that you're going to have a judgment against two guys that have put together entities, and you're never going to collect on it. And to this date, she's not been able to collect on her judgment. This is what entities can do for you if they're set up right. In fact, when I got this structure, it made me a little nervous that maybe these were my existing clients, so I had to run a check through the firm before I started advising her on this. But that's what you can do. So the key here is it's not a one-size-fits-all approach to investing, as you can probably tell. So many people go out there and they just want to set up LLCs for everything. How you set up the LLC is really important. Whether or not you use a corporation also needs to be considered. And that's why you need to evaluate your investing to make sure that the structure you're setting up is going to help you, and it's not going to hurt you like that one investor in Kansas who couldn't flip his multifamily building because it was set up wrong. So what we're offering, since you're here today, is I'm offering each and every one of you a free strategy session with our firm, where if you have existing structures, we'll go through, we'll review those existing structures, we'll perform a risk assessment, we'll tell you where your liability issues are and what you should do to minimize those areas of risk. I mean, just the fact you're a doctor right away is a simple one. I mean, the first risk is from your profession. And so what we want to look at is how do we protect your personal residence? How do we protect your investment accounts, your children's education account from potential creditors? In the strategy session, then we would look at discussing specific strategies that you could then utilize to minimize the risk to your assets. And so we go through all of this and also look at the various tax strategies that we could implement through the use of the entities to help reduce your taxes in areas where it makes sense. And so there's always got to be that balance when you're putting together a plan. You know, does the tax planning impair your ability to grow your business? So we want to make sure that we're doing something that's well balanced. And then we'll put together a blueprint that lays it all out and shows you what you should be doing today versus in the future, depending on the types of investments that you're getting involved with. This is always the key for us, is laying this out. It's like building a house. You got to start with the foundation. You just don't go and start creating entities. Oh, I bought a property here, so I'm going to throw an entity around it. It needs to be planned out ahead of time so you know going in to the situation how you're going to take that deal down. And that's why these strategy sessions are so valuable for individuals, so that they get a sense of, all right, if I'm going to be engaged in this type of real estate investing, then this is the general principles that I need to pay attention to and how I'm going to structure these deals. And this is an example of what those blueprints look like many times, so that you can then take a look or follow this visually as to where you're going to be going with your investing. So in addition to that, we give you access to our one-day real estate tax and asset protection live stream, where we have one going on right now. We teach these once, sometimes twice a month. It's a full day of this where we go really deep into these topics, like what I've been covering right now. It's slowed down. I'm trying to get as much in as I can within the hour, but we spend an entire day on it. And I'm also giving you a white paper as well, top 5 investment mistakes that doctors should avoid when it comes to investing. It's things that I've seen with all my medical professional clients over the years that I put into a white paper, so that going forwards, if you don't get a strategy session, get the paper, read it, and then understand what you should or should not be doing with your entity planning and structuring for your investing. And so to take advantage of that, if you want to get these, you just have to go to this link right here. It's aba.link/Xsite88. You go to that website, collect your information, schedule you out with a strategy session, download the white paper, and then from there, we'll start working with you. So I noticed that Sophie had a question here. She asked, does creating a separate LLC for each flip require creating an EIN every time you follow this process for a flip deal? Sophie, it really depends. So on the LLCs for each flip, we will typically set up an EIN for that entity, even though it's disregarded back to the corporation, so you can open a bank account for it. One of the things that happens with real estate investing, of course, is that when you go to title, where you go to sell, you're in escrow, title's going to cut a check to the name of the owner of the property. And since the owner of the property is a limited liability company, then you're going to have to establish a bank account in order to deposit that check. Few title companies on occasion will, I've been in this process where they'll actually send the money to another entity if I direct them to do it, but that's the exception, not the rule. So by having the EIN, you can then establish that account for the limited liability company so you can receive those funds on the flip deal. So the answer to that is yes. We always set up the EINs. And then since they're disregarded, the LLC does not have to file a tax return, because in that example I gave you, all the money is flowing to the corporation. The corporation picks it up for federal tax purposes.
Thank you so much, Clint. That was amazing. We have a couple of questions coming in on the chat.
Okay.
Actually came in, so I could just quickly go over some of those. And please, everybody, keep the questions coming, especially in the Q&A section, because Clint can see those too. Sydney Mbachu asks, can they search loan information to see the financial statements and disclosures? And she asked that when you were talking about the protecting the California LLCs with the Wyoming entity.
Yeah, they're not going to be able to search that. That's going to be private. They're not going to be able to see your loan documentation. What they could search is to see who's indebted on the who signed the guarantee, who's responsible for the mortgage. That is searchable. So even though you create that structure like I described, the backdoor way of figuring out who the actual owners are is to look at the deed of trust that is filed against the property if it's encumbered by a note. Now, most attorneys do not search this way. They only search title. And reality, whenever I'm doing an asset search on an individual, I'm searching the debt records on the property to find out who's responsible on the mortgage, because that tells me everything I need to know. Because I'm not going to be responsible on Julius's property or vice versa. So if my name's on there, then I know that somehow it's tied back to me. Great question. And that is one aspect, if it's not paid out, where someone could potentially find you that way if they know how to search.
Yeah. And I think KV's question about would they still find out the properties if you own the properties you own, since your name appears on the loan, kind of ties in with that same. And I think you answered that question. Mm-hmm. Yeah. And then Damaye did ask, how does this differ from a Delaware statutory trust? Is this better for investors operating out of California? Because she owns a property in California to avoid the franchise tax for each LLC? Yeah,
so I don't know if she lives in California, but she does. Okay, she lives in California. There's different ways to do it. Delaware statutory trust works as well. You can have that interest held by the DST. When you go with the DST, you're going to have a trustee in Delaware, so there's going to be some reoccurring fees for that type of structure. But when you're using the DST, many times there's still an LLC involved in a lot of those plans. So you have the property held by the LLC that you're a manager of. But instead of using the blue box like I'm describing, you're using the Delaware statutory trust so you can avoid the franchise fee. Here's an example of how if a client said, listen, I don't want to pay the franchise tax on my investments, then what we'll do is we'll create land trusts for our California clients. I didn't cover those today, just for time. But the land trust owns the property in California. And then each of the land trusts are held by Wyoming LLCs, like this. And then they drop down into this blue box down here, a different Wyoming LLC. This one is subject to $800. This stuff doesn't show up and it is not subject to $800 because of the way we structure it. So you have to pay it on this. And the reason you're going to pay it on this is because we're going to set it up as a partnership for tax purposes. Remember what I was talking about? Delaware statutory trust, to me, you don't want that flow through income. You want a K1 out of that LLC, not a disregarded income flowing down on your return. So you get a bump for your debt to income ratio. So I'm a strong proponent of, if you are in California, you've got to pay it on one of the entities. So if you have multiple investments, like I have like client, for instance, that I was referring to, this is an example of how I structured him on a lot of his properties. So that this is the California side, managed by a property manager up here, but this is what California sees right here.
Awesome. Great. Thanks. KB asks, can you convert the current Roth accounts into solo 401k? If not, is there a better way to utilize it?
Yeah. So if you have a Roth IRA, I assume is what we're referring to. So if I have a Roth IRA over here, then you need to set up a self-directed Roth IRA. We can't roll Roth IRAs into a solo 401k. They have to stay in the IRAs, traditionals. So if you were considering converting, what I often tell people, if you want the benefit of the solo 401k, what you should do is, if you got your current IRA right here, let's say it had 300 in it, roll that into the solo. So you drop the 300 into here. In the solo, you have a Roth account. You can do an in-plan conversion right here and roll that into the Roth account. You'll have to pay taxes on it, but that works. The other thing about the solo 401k is that you can actually put $57,000 a year into your Roth IRA through a solo if you utilize proper strategies to get the money in there. I have a few clients that we've set up that do this on an annual basis, and they're just blowing away their neighbors who are putting in $6,000 a year, and they're doing 10 times that on an annual basis because that plan is so powerful. But you always have to contrast that. If you want to pull money out of your Roth IRA, you think you want to draw upon those funds that you convert within after 5 years, then you're not going to want to do what I just described. Because when you roll into a solo 401k and you do an in-plan conversion, as long as it's inside of the 401k, you can't pull the money out until age 59 and a half or age 55 without there being a taxable event on a portion of it. Whereas if it was in a self-directed IRA, you could pull out all of your contributions, your after-tax contributions, after 5 years. So you have to kind of balance that out when you're doing this, what your motivations are.
Thanks. And Justice was asking, what about regular 401k? Can you invest that into real estate, or do you have to roll it into a solo 401k first?
Yeah, so there's two questions here. I got another one about, can you pull money out of a traditional 401k into a solo for use? So the answer to that is yes. With your traditional 401k that you have with your employer, you're restricted to equities. And that plan is drafted very narrow in what you can and cannot do with those funds. Many times you can't even roll out while you're still employed. So you're going to be stuck there in the equities until you separate from service. So unfortunately, there's not an option for you until you separate from service to set up a solo 401k, gain access to those funds. And when you're setting up the solo 401k, you're utilizing a provider like us or someone else who offers them, not a Charles Schwab or Smith Barney, because their plans are going to restrict you to equities. The plan that we draft, it's like wide open. You can do whatever you want inside of the plan as long as it's permitted under the Internal Revenue Code. And the only thing that's not permitted under the Internal Revenue Code with regards to your 401k plan is engaging in illegal activity, investing in alcohol, tobacco, or firearms, or holding S corporations. So other than that, a lot of opportunities there.
And Ebony was asking if this strategy session was available to people that do not have an existing structure. I think I can answer that, yes. Actually, this will probably help you set up a better structure for prospective or potential investments in the future. Great. I think Jifa had some questions in the Q&A.
I saw that about the Series LLC.
Yep.
Do I recommend the series? Absolutely. If you live in a state or you're investing, not live, excuse me. If you're investing in a state that recognizes a series limited liability company, definitely I set those up a lot for clients because I think that it's in better form from a maintenance standpoint to go with the Series LLC. If you're not familiar with it, let's assume that you're going to invest in Texas. So what you're doing, actually, let me go back to the same colors. So I drew this many times. I said, create a separate LLC for each property, okay? Now, with each LLC that you set up, that's a separate filing fee. So 3 LLCs, 3 filing fees. For the Series LLC, you create one limited liability company, but it gives you the ability to create cells. And each cell that you create does not require an additional filing, with the exception of Illinois. And I'll circle back and I'll tell you the importance of that here in a moment. So you have a filing fee here, but not on these 3 separate LLCs. So you avoid the filings, number one. Number two, these are operating agreements that you set up. Our standard operating agreement is for an LLC disregarded. Real estate is probably about 65 pages in length. These operating agreements here are typically 2 to 3 pages in length. You just fill them out when you want to create a new entity, because when you set up a cell, it's treated just like it's equal to a LLC. So these are all equal here. They're treated like separate limited liability companies. So you put a piece of property in a cell like this that you just set up. Anything goes wrong, all you do is you just lose that cell. That's it. Just like if you lost an LLC. All the other properties remain protected. And we'll typically have each cell owned by the parent down over here. Now, series LLCs, there are people out there that set them up and run into a lot of them. They're not doing them the right way. They don't understand what they're doing. Case in point, a couple of weeks ago, there was this appellate court decision rendered in Illinois. They set up a series LLC, and it was a real estate deal, real estate investor, and he was operating out of this cell right here. And this cell came under attack. Well, actually what they did is the plaintiff sued the parent. They didn't sue the cell. And they stepped up and they said, whoa, wait a minute, you can't sue the parent, you have to sue the cell. Well, the operator of this structure didn't set it up the right way, did not register the cell in Illinois, didn't go through the proper procedures to ensure that the liability stayed contained within the cell. And they said because they didn't do that, they could sue the parent company. So series LLCs, they are recognized. States do recognize the separateness of the cell if you do it right. So that's one of the drawbacks. I mean, with a traditional LLC format, if you went on Zoom and you created your own structure, you're going to have some protection there. You can't screw it up too bad. But with a series LLC, there's a lot of potential for messing this structure up.
Jifa also asks that, I'm in private practice and I have my business set up as an S Corp. Mm-hmm. I'd like to keep the S Corp structure for liquidity, but wanted to also set up the real estate business as a C Corp, as you suggested. Would
that assumes he's going to flip then. If he's going to flip, yes. But I would ask, well, first off, you have to have two separate companies. You couldn't take your medical practice and flip real estate through it. That's suicide, number one, for your medical practice, because they'll probably pull your license for that company because it's engaging in another activity. It's not related to the medical profession. Number two, if you set this up, I would assume that you are going to be flipping real estate. This is not for buy and hold. It's only for flips. Now, if this is my medical practice over here that I'm working in, you say liquidity. I'm not sure how that actually plays into it. I would run an analysis to see if you're better off as a C Corp, because let's assume that I brought in $400,000 in my S Corp and that all flows down to me. Well, lenders see that and they evaluate your S Corp when you go in to apply for a loan to buy this piece of property over here. And you've probably been through this before if you've ever applied for financing. They want to see the tax return, P&L, balance on that company. They want to sometimes they want to evaluate your receivables that you have. What is the likelihood? What is the default rate on those? Insurance. But if it's a C Corp, then they don't know you're in business for yourself because you only show up as a W-2 wage earner. And I'll give you an example. So I recently purchased a new residence, and when I went through the process of obtaining the loan, it was so frustrating because, again, my corporation, my law firm, still shows up on my tax return because they wanted 3 years in this case. So they knew I had the business, even though it's converted to a C. So of course they said, well, you own firm. I said, it's no longer an S Corp, but they knew it was, so they wanted all this information. And they just started putting me through the ringer. And the funny thing about it that's so frustrating is that if I came to them strictly as a W-2 wage earner, and I showed that I made $400,000 a year, I'd have no problem qualifying for this loan. But the fact that I come to him as a business owner who makes $1 million a year through his business, I had a problem qualifying for the loan. I mean, it just astounds me. I made plenty of money, 10 times over what I needed, but it didn't matter. It's how I made my money that impaired my ability to qualify. And I had to go through 3 different lenders to get the deal done. And that's why I'm so dead set against S corporations for real estate investors, because you just don't know. And if you have a seller on the other side that, in my case, they extended closing, but they extracted concessions from me. that I did not want to give. But because I knew I wanted this property, I had to provide them because my tax returns would put me in that situation. So I would evaluate it to see whether or not the S Corp is truly benefiting you the way you think it might, especially how it plays into real estate.
Excellent. Damia asks, how do these structures hold up in an IRS audit when you have multiple operating or series LLC of which you're paying taxes for the parent LLC, but not the multiple LLCs under?
Beautiful. Let me show you something here. So the structure that I was drawing for you, let's say this structure right here, from an asset protection standpoint, this is what you see on your diagram when you create this stuff. You'll see these entities right here. So this is you. If you set it up the way I described, what does the IRS see from a tax standpoint? They only see this because those red boxes are disregarded. They don't file tax returns. They're ignored by the IRS. So how does that impact you in an audit? It doesn't hurt you or help you one way or the other. It's just all coming through this company right here via K1 that shows up onto your return. Now, so this is what the IRS sees. Now, what does a creditor see if somebody was sniffing around and they wanted to come after you? This is all a creditor sees with our structures. See the difference here? This is what you see because you're in complete control. You set it up, you know what you have. The only thing that gets reported to the IRS that they're paying attention to is that blue box because this is a partnership. But from a creditor standpoint, that someone that's coming after you, they don't see any of this because they don't have access to your tax returns, number one, so they wouldn't see the blue box. And because of the structure that we created, the way it's set up, none of that ties back to you through a public database. So when they run the asset search, they don't know that you have this structure right here, of course, owning the real estate that we were describing. Just like that, and then your brokerage account somewhere down there.
Awesome. Thank you so much. KD asks, when should I obtain commercial or SBA loans under personal name or under corporation?
Okay, so SBA loan puts you in a different category altogether. When you're working with an SBA lender, the first thing that, since it's going to be most likely commercial, you're going to acquire that property in a limited liability company. Now, whether or not it has to be part of your business, you have to ask the lender in that context what they want in order to make that loan go through. So the SBA is slightly different. Ideally, what you would do is have an LLC set up for the acquisition of the building. And I assume what you're doing is you're going to enter into a self-lease arrangement where you're buying the building for the benefit of your corp here, and you're going to lease it over to the company. So ideally, you'd want to use the LLC in this way to set it up. But I've seen situations where they require that either the property be owned by the business, or if it's not owned by the business, that the LLC be owned 100% by the business. And that's not the best scenario. Definitely this is better than having the building owned in the corp, but the best scenario, of course, is always going to be, no, we have common owners here and here that own it, and go that route. But you're going to need to check with the lender beforehand and just ask them, hey, can I set this deal up? I want to own it through a separate special purpose LLC that I'll be a member in. Can I close that way? And see what they say.
Thank you, Clint. Just the last question. For a lot of our potential investors or folks in our network, they are busy professionals, and a lot of them are also interested in passive investment in maybe multifamily real estate or other forms of real estate. What is for those that don't have the time to set up a lot of things right now, what is the best entity to invest in, for example, syndications as a passive investor?
Wyoming Llc. That's what I would do. Here's why. You get involved in the syndication. syndications make distributions, either on a liquidity event, refinancing of the property, or just on monthly cash flow. So if I have an LLC and Julius, you do not. So you're in there, you're down here, and this syndication has $100,000 to distribute to us. And let's just say we're 50-50, just to make it simple. So that means you're entitled to 50, I'm entitled to 50. Well, the operator of the syndication has to distribute the money. He doesn't care. He's just going to distribute the cash out, 50K to you, 50K to me. Let's just also further assume that you're involved in a litigation, or maybe you just wrapped it up and there's a judgment against you where they state that you were negligent and you owe this plaintiff $1 million. So what's going to happen is they're going to put what's called a charging order on your syndication interest, which means that any money you get out of the syndication has to go right to your creditor. So when they drop the $50,000 down to you, it ends up going over here to your creditor. Now let's also assume that I'm involved in the same exact lawsuit and I owe someone $1 million, but I own my interest through a Wyoming Llc. So what'll occur is they'll come and they'll say, Clint, you owe $1 million. We're going to put a charging order on your blue box interest. So if you get any money out of your Wyoming Llc, you got to pay that money over here to the plaintiff. Okay, so we're in the same exact scenario. But the difference is when my distribution from the syndication comes to me, it comes to a Wyoming Llc that I'm in control of. It doesn't come directly to me and by default right to my creditor. It goes here. The only way it'll go to my creditor is if I choose to take a distribution out of the blue box. I bet you I would never take a distribution out of that blue box as long as that creditor's hanging in the wings. I would just accumulate the cash down here. And what could I do with that cash? Go up and set up other LLCs and invest through there and just keep it all protected from my creditor. Or even better, don't take a distribution. Take a loan out of my company. If I needed money, I'll just loan myself money on terms that I find agreeable with myself. Take it out that way. That's not available to my creditor. Or if I'm going to work for the company, pay myself a W-2 management fee. That's not available to my creditor. My point is this. You're protecting your investments from your personal creditors because the syndicator doesn't care what problems you have. They're going to send the money wherever they're told to send it. You're in a situation where you have no control over your financial future here. I'm in a position where I have control. So for those types of investors, I would set up the Wyoming Llc to own their syndication interest. I'll show you real quick what we typically do. Set up your personal residence here in a land trust and use a nominee trustee. So it's either, I serve as this for a lot of clients. Thousands of properties I'm listed as a trustee on their trust on title, even though I don't even have any interest in it, I've resigned, but it protects their property from creditors. So you have your property here in a land trust, no longer associated back to you. You take your LLC, you set it up here to hold your syndication interests in various deals that you're investing in. And then if you have savings and brokerage account, you also put that inside of that LLC. So the only thing that you keep in your personal name would be, your vehicles would be in your personal name and your boats, things like that, but your real estate inside of a land trust. Now, this doesn't provide asset protection. All it does is it takes your name off of title. So if somebody ran a name search, they would not see that this title is any longer in your name. And if they dropped a judgment against you. So the way a judgment works is I record it in the county where I think you live. So let's assume that you lived in Queen Charlotte County. Then what would happen is if I recorded that $1 million judgment and you had that house in your own name, if you tried to sell or refi the house, $1 million out of either deal would go to your creditor because it's in your name, the judgment attaches. But if you put it in a land trust, the land trust is no longer in your name. So you can sell and refi out of the land trust without the creditor getting paid because the judgment won't stick to the trust. It only sticks to you. So that's how we also protect medical professionals for their residence. Now, if you live in a Texas or Florida, unlimited homestead exemption state, not so critical. And again, but if you do intend to sell, then you convert what is statutorily protected into now a non-exempt asset at that point in time upon a conversion from real property into personal property. So that's what I would do. Land trust and a Wyoming LLC.
Thank you so much, Clint. I think we're up on time. Thank you, everybody, for joining us for this fantastic webinar. I mean, Clint, you definitely dropped a lot of gems. Thank you. I really do hope that a lot of our attendees and members of our network will take advantage of the strategy session. We will be following up with some emails. So if you find this educational and you find this valuable, Xsite Capital is also going to be providing more information and more educational opportunities like this to you. So please feel free to check our website, sign up, and sign up for our newsletter. And we look forward to interacting with you and collaborating with you and helping to grow your wealth and grow your mind as we move forward. Thank you, everybody, and thanks so much, Clint.
All right, take care, everyone. Thanks.
Yeah.